Okay, so I've started the recording. So I think one thing I want to make clear, because this is from a regulatory standpoint, is that um, you know nothing in this is meant to be advice. So it's just a discussion, and if you decide to act on something based on this, then you should do that either by doing your own due diligence or working with your advisor. So nothing on this is like meant to be a recommendation or personal advice, whatever, right? So, I hope that's well understood. Okay, so everyone could probably mute because I'm going to probably stop at certain points, but we have a lot of things to cover, and then we have half an hour later for discussion. So I'm just going to sort of motor along in that. So first, I'm going to start with this Excel, which basically tries to answer this question to PMS or not to PMS. And the thing is that one of the things where if you do any active fund manager is it's a good thing to try and understand what is the process. And even if they've achieved returns over time, how much of that has been due to skill and how much of that has been due to luck. Now, this is not very easy to do. But in any case, we'll get into this and I'll show you some data sources and ways that you can do this. Okay. So what we're going to do is that one of the people who requested me to analyze their PMS, was so she gave me her PMS statements and this, that, and the other. And I've disguised all that. And there were two PMSs that she had invested in with the same PMS provider, 75% in one PMS and 25% in the other PMS. So that's what this PMS 1 and 2 is. Okay, so I'm going to give you the sort of conclusions and then go into the details. So the amount invested was about 18 lakhs 75,000 in one PMS and 56 lakhs 25,000 in the other PMS. That are these numbers here and here. And this was for approximately a period of 2 years, and it grew to 2987 130 and 92 1960. So this is a PMS. Both these sub PMSs also were in the top quartile of PMS providers. So this was a good PMS. Okay. So then what I tried to do was I tried to analyze this and said, did PMS2 beat a simple index portfolio? Like a simple index portfolio, we're talking about where you try and put it into, say, 75% into an Axis Nifty 100, or I'm just saying Axis for, it could be any Nifty 100, then 20% into a mid-cap 150 index, and sort of 5% into a small cap index. So in this case, the PMS did, and by about 8%, okay, in the period that was there. And I'll show you the detailed analysis. Then did the PMS2 beat the Nifty 500, right? So instead of these three funds, could you just put it in one fund? And it did, and there was a slight difference between the two, the deconstructed Nifty 500 and the Nifty 500, which was this thing. So it was like 8% and 10%. Then did the PMS2 beat active mutual fund smart index portfolio? And the answer was no, and the difference was 8%. Did PMS2 beat Motilal BSE enhanced value? And the answer was no, and the difference was 43%. Okay, the gap, right? So we'll see all this. So this is basically the analysis. And the analysis of PMS1 was kind of similar. Okay, so that's it. So the notes are you should study the stocks owned by the PMS and by the active MF to see what you're more comfortable investing in. In the future, PMS may not perform, or the active MF you choose may not perform, right? So the basic thing is that this is all the past, right? And so you can analyze the past that may give you some insights into the future, but you have to really make a prediction about the future, and you may end up being wrong, right? So what are some of the PMS pros and cons? Okay. So they manage smaller amounts, they can be nimbler, could be very good stock pickers, tend to be more expensive than active MF, but that may not always be true. They are a little bit opaque and not that well regulated. Exiting may not be easy. There may be exit loads and things like that, and it may take time. The fund manager of a PMS is likely to be more stable. They are not going to change. Okay. Then there could be less restrictions, but that could be negative in the sense that the mutual funds have a prospectus, they have some restrictions. So here they have less restrictions, which could be a positive, but it may be a negative. There are expenses and taxes in addition to the management fee. And the high minimum amount brings some sort of a psychological benefit to some people. They feel they're special, right? Because they're doing PMS, they can talk to the fund manager, they get nice reports. So it's like belonging to a club. You know, you feel, yeah, these mutual funds is for lesser beings. You know, I'm special, right? So that could be this thing. And in the active MF, pros and cons, that it's well regulated, in out easy, open-ended, daily NAV. After 1 year, no exit loads. It's some no exit loads anyway. Easier to compare. And the fund manager may leave, not a problem for smart index. Smart index algo may also stop working, right? So these are some of the sort of overview things. But now, at this point, if anyone has questions, please unmute yourself and ask a question. But otherwise, we'll move into actually a lot of detail, right, of how these things and where you can get information, right, to make your own decision. Okay. So are there any questions? Okay, so let's now look at the how I analyzed, right? So PMS 1, the allocation was this, the amount was so on and so forth. So there were these 34 counters and cash, right? And this was the quantity, this was the average cost, this was the last traded price, this was the current value, this was the PNL. So you could see that in this particular thing, quite most of these counters had made gain, though there were some losses in there. And this was the change, this was a weight. And then I went to ticker tape, which I'll show you. And I looked at each of the instruments and stocks and categorized them into small cap, mid cap, micro cap, and large cap. Okay. So then I found out what was the weight of this in the PMS portfolio. Like, so it was 26% small cap, about 18% mid cap, 12% micro cap, and 42% large cap. So now, if this PMS compares itself to the Nifty 500 or the BSE 500, in some ways, it's wrong. I mean, the comparison is okay, but basically the BSE 500 has about 75% in large cap and 20% in mid cap and 5%. So this has a different allocation percentage, which probably helps it beat the BSE 500 in as long as its allocation choices are correct. And maybe that's what you're paying for. But it is good to recognize that, right? Because when you're trying to analyze it against other alternatives, then looking at this composition is very important. Okay. So this is the first step, that if you take your PMS and you lay it out like this, okay, then you can try and see what are the, because this in some ways also defines the risk that you're taking, right? Okay. So moving on to, I did the same thing for PMS2 and I got these percentages, right? Then I did the analysis for, let's take PMS2. So here is the analysis. So first is the invested amounts and dates. So like this person actually added the bulk of the money in two tranches and then started doing an SIP in the thing to get this 18.75 lakhs, right? And these were the exact dates when they added it and what was the, how this amount came. Now, if you want to do this in a very exact fashion, you can take your alternatives. So the alternatives are the Nifty 100, blah, 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 all these kind of 6, 7 funds or 8 funds that I chose as possible alternatives. And then I combine them and I can get the NAV on those particular dates, exact dates of the direct version of these funds. Okay. So this is the NAV table here. And then I said, okay, if I'm going to meet, then there are 3 funds, the Nifty 100, the Mid Cap 150, and the ICICI Nifty Small Cap 250. Now, these numbers, this 71.6 and 25.6 and 2.8, they are derived from this figure here. Like the 71 is basically 65.59 plus 6.02, which was the cash component. I put that in large, and the 25.6 and 2.79 are here, right? So in some ways, I'm assuming that this allocation, which was a snapshot at the end for this PMS, did not change very much during this period, right? So that is the kind of assumption in there. And so that's this. And then I said, okay, if you did that, then this particular money, the 50 lakhs, which was, or sorry, 12.5 lakhs here, how was it broken up? So it was, if you take that 12.5 lakhs, multiply by 71.6%, and then divide by the NAV. So you got so many units. So I did this, and these were the units that you ended up with. Then I multiplied that by the values, and then I got the total as to what would be the total value at the end of this period. And this is what's there in the summary here, right? So this was the analysis which was done. Then there was this other thing of beat, right? So in beat, I took not the, so I took the Parag Parikh Flexi Cap, which is one of the better large cap ones, at least in the past. And then
Sanjay, let me just interrupt here. You took from her mutual fund portfolio what she had chosen for B.
no, but I'm doing this in general, so it doesn't matter for her or whoever else. I'll show you where I got these from, why I picked these particular funds through the, because I want to show you something called Explore Funds on Bharosa Club, where I picked these particular funds. Okay, so I got these 4 funds, which is this Motilal BSE Enhanced Value, Quant Small Cap, Quant Mid Cap, and Parag Parikh Flexi Cap. And then again put these ratios to this, right, in there. And then I did 100% in the Nifty 500, and then I did kind of 100% in the Motilal BSE Enhanced Value. I had to do some minor adjustment because in June 2022, this particular fund was not there, the Motilal BSE Enhanced Value. So I put it half and half into quant mid cap and small cap, right? And I got these kind of figures. So this is how I chose to analyze and compare the PMS with a wide choice of funds. Okay. So now what I'm going to do is I'm going to show you some things here, which are So first, I'm going to show you something on how can you compare mutual funds, right? So this is from the Explore funds on Bharosa. So all these quant small cap, quant mid cap, Parag Parikh flexi cap, Motilal Oswal, S&P, BSE enhanced value, iPro Nifty small cap 250, all these funds, these 8 funds are put here, right? Now, if you see these, okay, you will notice that you can get a good side-by-side comparison looking at the 5-year performance. So wherever there's a blank, this thing hasn't existed for 5 years. So the quant small cap has given you a 42.3% return, right? So like in the pre-discussion, someone had mentioned that they'd gotten like an 18% return or something like that, or 18, 19% return over, say, 6 years, something like that. But let's say 5 years. Then if you had put it 100% in quant small cap, you would have got 42.3, mid cap 37.1, Parag Parikh 25.1. So basically, your PMS didn't do all that great, right? But so similarly, you can look at 3 years. Now you can look at 1 year. Now, in the last 1 year, so yes, PMS has given good things, but look at this. What has the mutual funds given? 64.3, 73.1, 36.2. This one, which we are going to focus on a little bit, Motilal Oswal, S&P BSE enhanced value, that has given 92.7, 59.2, 54.3, and so on and so forth. And you'll also notice that this the bundle here, the Nifty 500 has given 34.1, and there's something called the Bharosa bundle here, which is the deconstructed version of the Nifty. This thing, that's given slightly more, 36.2%, right? So you could also look at other features besides performance. So if I go into this detailed thing here, then you can see what is the size of these, right? So this Parag Parikh has 64,000 crores, right? This Motilal Oswal S&P BSE enhanced value has 401 crores. So it's got this 92%, but not too many people know about it or whatever. So for that reason, it's not got a lot of money. Now, if you look at the fees, and these are all for the direct versions, okay, then you'll see that the fees are 0.38% for this one because it's an index fund. While for the active mutual funds, it's a little more, right? So this is something that can help you compare things. Okay. I forgot one thing on the Excel, sorry, so I'm going to go back to that. So here, if you look at the fees tab here, so actually I'll come back to this, sorry. Okay, so then the thing is now, where is there information about how can I compare mutual funds? PMS. So is there any place where I can get information on PMSs? So there is. So you can go to this thing called APMI, which is the Association of PMS Managers of India, and they have things. So here, if you go to the Consolidated Investor Advisor Performance Report, and I've picked one here just for illustration. So it's like Deserve Investments Private Limited, because quite a few people like the UI of Deserve. It's a new age company, etc., etc. So I keep getting some queries about, Deserve. So they also have a PMS thing, which they try to get you into. So how is they have something called ERS, so Equity Revival Strategy. And this is the thing that, so this shows that they are a second quartile PMS provider, right? So to be a first quartile PMS provider in 1 year, you should have had 52.81% return. That was if you had more than 52.81, you would get into first quartile. If you had more than 40.77, you would get into second quartile. They had 43.81. So they are somewhat at the relative bottom of the second quartile, right? So another way of saying it is that probably 40% of the PMS funds have done better than this particular fund. So when you are selecting PMS, trying to go here and look at how they have done, and not only that particular PMS, but you can look at all the PMSs that this fund PMS manager has and how have they done, right? Because like here, if you see, there was a PMS called True Beacon. Okay, and if you look at this, so they have this equity factor quant, and if you submit this, they are top quartile. Okay, but if you go to bespoke equity and submit that, they are bottom quartile, right? So I got an unsolicited email telling me about this equity quant, whatever it was, whatever the name was, and because I knew about this APMI, I went to APMI and I looked. So this gives me a sense saying, okay, this might be doing really well, but is it a flash in the pan, or is it something which actually is pretty good, right? Is it more luck that 1 year it's done well, and so on? So this is this APMI thing. Okay. So this person, asked me that, okay, I found this particular PMS through this APMI kind of thing. So what do you think of that? So she gave me the sort of fee structure, right? So this particular PMS was a top quartile fund with zero management fee and 15% of gains with high watermark. Now, this is pretty interesting because they're saying, hey, I'm not going to charge you a management fee, and I'm going to charge you 15% of the gains. And also there'll be a high watermark. So if the thing goes down, then I still have to reach that high watermark. Only then will I start charging you fees. So I did some sort of an analysis where I said, okay, if the return was 13.1%, which is again from this rolling returns playground on Bharosa, including the global financial crisis and all, which is why it's low on equities. It's like 13.1%. So in 10 years, this 3 crores would grow to 10.27 crores. 10.27. Now, if they were able to pick better, so I said, okay, let's say you got 16%, then it would be 13.323% thing. So then I said that, okay, if the fees were 15%, okay, then what kind of a return would they have to get if they were like investing conservatively? So I got 15.4. That means that they would have to outperform by 2.3% to get the same 10.27 crores. And the fees I would pay them would be 1.28 crores on this 15% thing. Okay. So here, if they tried to be more aggressive and we use this kind of benchmark, then they would have to give a 19% return and they would have to outperform by 3% to match this. And the fees I would pay would be 1.83%, 1.83 crores. Okay. So this generally gives you an idea of how you can kind of analyze the fees and all. And it's pretty important to understand what you're getting into and not necessarily just saying, oh, this sounds good, right? Like they're only taking 15% in there. So that may be okay, right? And it definitely aligns incentives and all that, but it's this kind of thing. Okay. So moving along, so we looked at this thing. So now one of the things that we picked up in this thing was that there was this S&P BSE Enhanced Value Index. Okay. So I found out about this because someone told me about it. So then I started looking at it. And then I said, wow, like their 1 year return is 89.46%. Their 3 year return is 36%. The 5 year return is 29%. And the 10 year return is 13%, right? Not all that great. So anyway, so this sort of was intriguing, right, in terms of this whole thing. So then I said, okay, let me look more at this. And then, I found that there's a fact sheet and then there's a methodology, right? So here is the fact sheet. So if I look at the fact sheet, it talks about how this index gets done, what the process is, which I have frankly have understood a little bit, because I don't have a personal interest in investing in this because I can't. By being a US citizen, there are some tax laws in the US which make it difficult for me to invest in mutual funds or ETFs or PMS or anything like that. So I had no personal interest, but anyone who does, what I'm trying to tell you is that these resources are available. You can spend time thinking about it, looking at it. So it's got a lot of information. You can see all this kind of stuff, and you can look at the returns, the annualized returns here, et cetera, et cetera. They have the calendar year performance. They have now this I don't understand, but they have something called annualized risk adjusted returns, where it talks about what these are and what the annualized risk is, what the fundamentals are, the number of constituents, and what a lot of stuff right here. So that's what I was saying, that with these kind of things, you kind of understand the process if you spend the time to understand the process. Okay, then you have here the methodology, right? So this is 32 pages. Okay, so but you might be interested, you might be a quant guy, you might have an advisor who really understands all this. You can spend time on it. You might have someone in your family or someone who knows this stuff, and you can check with them, or you can find an advisor who's really good, who can go through all this and tell you something about it. So this is another page which is from SEBI. So SEBI asks portfolio managers to give reports. For some reason, this page isn't working, but I guess at some stage it'll work. So maybe SEBI is not that keen on making sure that all its pages work, but that's fine. This thing here is ticker tape, which is something that I used to take each component of that PMS and categorize it. So here it tells you that whether this is a large cap or a small cap or a mid cap. So like this company Hindalco is ranked 57, and it is a large cap. 87% of analysts recommend that you buy it, and it's given some kind of a 61% return in the last year. Now, why I picked Hindalco was that you can go to, so there is a fund which tracks this BSE Enhanced Value Index, which is a Motilal fund, right? Because if you just have the index, how do you invest in the index? You can't, right? So either you have to have an ETF or you have to have a fund which tracks this. So then you can look at the entire portfolio of this thing. So it's not a black box, right? You know what the components are. So then you can say, hey, so essentially this particular index fund invests in low PE, like it looks at 3-4 factors, right? If you look at this thing, so it says, measures the performance of 30 companies. So it chooses 30 companies from the S&P BSE large mid cap with the highest valuation based on 3 fundamental measures: book value to price, earnings to price, and sales to price, right? And so this is how, and then it goes into this whole construction. So based on that, these are the 30 stocks that they have picked, right? So you can look at that. Okay, then okay, so we got this, we got this. Okay, so I'm now going to come back to, so it also tells you here in the Excels, 1 minute. Just give me a minute. It's hard navigating all this. Okay, so here it tells you what have been the changes to this index. So it says that on 18th March, okay, they added these 5 stocks to the index: Indian Bank, Bandhan Bank, Grasim Industries, UPL Limited, and Jindal Steel and Power. And they removed these stocks: Coal India, NTPC, Tata Steel, NMDC, IRFC. Now, one of the things, if you really look at these 5 stocks that they removed, these stocks all went up like massively, which probably explains why this index did so well. But the reason they removed it was it no longer probably fit that criteria of low price earnings, this, that, and the other. So they removed it and replaced it by some others. Okay. So that's what this means. Okay. Then there is this whole business of the reconstitution calendar. So if you look at it, when is this thing reconstituted? So it's reconstituted on 18th March, which was this thing I showed you. The next reconstitution will be on 23rd September, 24th, right? So to some extent, if you invest in this, you should, or your advisor should, kind of maybe a little bit know all this, follow it, say what you're doing, etc., etc. Same way, if you invest in a PMS, then you should essentially look at what the PMS is really doing, ask questions, which a lot of the PMS people, because they have relatively few customers, and the better PMSs, maybe with relatively higher things. So if you are qualify for that, they may entertain you, and they may spend a fair amount of time with you answering your questions and stuff like that. Because as you can see, that for this particular individual, if they had 3 crores, then they stand to, over 10 years or so, make a fair amount of money from you, right? And one shouldn't begrudge them that money, because if they've delivered value to you, why not? Right? Why not? Why shouldn't they make that money? But you want people who will do their homework, and not just kind of this thing. So I think I'm more or less done. I'm just looking at Anita, do you think I've missed anything?
No, I
Hello?
think that's fine. I think that's fine.
Okay.
I think what you missed in your spreadsheet,
Hmm.
in the summary thing, is that that's just my observation, is that you gave PMS a slight advantage because that's without tax.
Oh, okay. Yeah. Yes, that is correct. Right. And I haven't taken any exit loads or things like that. So I did
Correct.
my thing that, that number that I took as the comparison number, it will,
Go back to the sheet.
yeah, just 1 minute. Yeah. So I said that the exit value before taxes will be less than 2,987,130. And in the middle, you may have paid some taxes. Right. So that would have been a negative cash flow. So here, when I do the cash flow analysis, if I was to do it strictly, then this amount should be enhanced by the amount of tax that you've paid also, right? Like, so because that's been money that's gone out of your system, right? And that tax you wouldn't have had to pay if you were in the thing. But here, again, I am not so concerned about being very precise here, because the basic thing is that this is all the past. What you're trying to do is just get an idea, and because you've got to decide what you want to do in the future. Okay. So I think I'll stop here and see if there are any questions. Otherwise, I'll stop the recording. I think I did it much faster than I thought I would do it, but that's good. And then, those who want to like have an open discussion can stay on, and we can end the meeting whenever people are done. Okay, so are there any questions that we want to cover in the recording? Okay, looks like there are none. So I'm going to stop the recording.